Investing Basics, a simple guide to fund pricing. Open-ended funds, unit trusts and OEICs, pool money from lots of investors to buy a basket of investments. The price of these assets fluctuates, as does the size of the fund as investors buy and sell shares. Pricing a fund in a way that is fair to investors is complex. Here are the basics. A fund's price is based upon the value of the assets, the shares, bonds, or property it owns. The calculation includes spreads. Assets may have a bid-offer spread, the difference between the cost of buying or selling a share in a company. The spread may be very small on widely traded stocks, or significant on small, illiquid stocks. Transaction costs. External costs, including commissions, transfer fees and stamp duty. Costs vary widely, depending upon the type of asset and where they are. Initial charge. Applied by the fund manager for setting up the investment, although often fully discounted. There is a buying and a selling price for every fund. The quoted price depends on the pricing method. Managers seek to treat investors fairly, whether they are buying, selling, or staying invested. Ordinarily, the costs for buying or selling assets are taken from a fund's capital. When the fund expands or contracts due to investor flows, additional costs may arise. Single-priced funds. Most OEICs and some unit trusts operate on a single-price basis. Investors can buy or sell shares from the fund manager at the same price. The price is the midpoint of the buying and selling point of the fund's assets. Net asset value per share is the fund's assets less liabilities, divided by number of shares. Single pricing works well when the number of shares bought or sold is relatively small. With higher volumes, the manager can impose a dilution adjustment to protect existing investors by transferring costs to those joining or leaving. Dual-priced funds. Some funds have a quoted offer and a quoted bid price. The difference is known as the spread. The price at which you buy units, or shares, the offer, reflects the price of the fund's assets plus buying costs and initial charge. The price you sell at, the bid, reflects the selling price of the assets less selling costs. On any given day the offer price is higher than the bid price. For much more visit DIYinvestor.net.